The current market for Archer Aviation Inc. (ACHR) is showing a strong reaction, with the stock trading at $7.76 USD, marking a significant decline of 12.67% intraday as of the time of this analysis. Now, the headline figure of that massive drop is going to lead most investors to a very simple negative conclusion. The third quarter earnings report, which came out just a day or so ago, must have been a disaster. That is the expectation. The reality, however, is far more nuanced, and it's the dilution, not the loss, that is the true anchor dragging this stock down, which is the immediate insight that most people are missing when they just look at the price chart. The company actually narrowed its net loss to $130 million, beating analyst expectations for the loss figure, which typically would provide a small sigh of relief for a high-growth pre-revenue company like this. But that news was completely overshadowed by the secondary stock offering, a massive sale of 85 million shares, part of a plan to raise $650 million in new equity capital. This is the classic high-growth stock paradox. The company is raising capital to fund necessary, large-scale strategic moves, like the simultaneous acquisition of Hawthorne Airport in Los Angeles, which is a key physical asset for their long-term air taxi network plan. But the method of raising that capital, the significant share dilution, is what immediately punishes existing shareholders and tanks the stock price in the near term. The general belief, especially among retail online investment accounts and people using platforms like Robinhood for quick trades, is that the electric vertical takeoff and landing, or EVTL, space is simply too capital-intensive, too far from profitability, and too reliant on future technology that hasn't fully materialized yet. When a company announces a huge share sale, it validates this fear. They clearly need a lot more money to get to market, and they're choosing to get it by making every existing share worth less. That's the common ground of skepticism right now, and it's a fair point to make. But here's the contrarian take that forces a rethink. For a moonshot technology like this, liquidity is a weapon. Archer Aviation now boasts a sector-leading liquidity position of over $2 billion in cash and equivalents. Their competitor, Joby Aviation, also recently announced a discounted share sale, which shows that capital raising is simply the cost of doing business in this industry right now. Archer is making a clear choice to trade short-term stock price pain for long-term financial security and strategic physical assets, like that Los Angeles airport, which is a crucial step for establishing a network ahead of the 2028 Olympics, where they are the official air taxi partner. This move is a highly aggressive, high-stakes positioning play, securing a critical piece of infrastructure and doing it with a massive cash buffer that competitors may not enjoy. The question for investors isn't just, why did the stock fall? It's, is a $2 billion cash runway and a key LA hub worth a one-day 12% drop and significant dilution? For a business model that is a decade-long play, many serious institutional funds, some of whom use specialized Fidelity investments platforms, will look past the day's volatility to the longevity the cash infusion provides. The massive dilution is a one-time surgical cut intended to fund the company through the very long, expensive process of FAA certification and manufacturing scale-up. The high trading volume today, over 67 million shares, reflects this tension, with a huge number of retail traders selling in fear of the dilution, while a select few institutions, perhaps even Cathie Wood's ARK, are using the weakness as a chance to accumulate, betting on the long-term strategic execution over the short-term financial mechanics. Let's expand on the recent stock movement. The stock had an incredible run-up to its 52-week high of around $14.62 just a month or so ago, fueled by a wave of overwhelmingly positive news, successful flight test milestones, including their longest piloted flight of 55 miles, a major partnership with the Tokyo Metropolitan Government and Japan Airlines, and a massive defense contract push. These were the expectation setters. The market had started to price in execution and forward momentum. But when a stock doubles or triples in a short period, as Archer Aviation has done off its lows, it becomes extremely sensitive to anything that slows the narrative. The Q3 report, while not a disaster on the loss side, introduced two major unavoidable headwinds: the dilution and the reality of the continued heavy cash burn, $126 million used in operations last quarter. The stock broke sharply below its 50-day moving average, a common technical support level, following the news, and the lack of a strong rebound is a clear signal that the dilution factor is dominating investor sentiment. Many quantitative intelligent portfolio strategies will have automatically triggered a sell-off due to that technical breakdown and the sudden change in the share count, amplifying the drop. The defense program continues to be a quiet catalyst as the company aggressively pursues government contracts for dual-use eVTOLs, which could provide an early, stable source of money before the commercial air taxi market fully opens. This diversification is key and often overlooked by simple retail analysis. When we consider the underlying business, Archer Aviation is fundamentally an aircraft manufacturer and, perhaps more significantly, a future transportation network provider. Their core product is the Midnight aircraft, an electric vertical takeoff and landing vehicle designed to carry 4 passengers plus a pilot for urban air mobility, essentially an air taxi service designed to complete back-to-back flights with minimal downtime for charging. The business model is multifaceted. Initially, it involves the sale of aircraft to fleet operators, most notably United Airlines and others globally, and then the more lucrative long-term opportunity is the operation of the air taxi network itself, controlling the vertiports and the software that manages the air traffic. This is where the acquisition of Hawthorne Airport, now serving as a future hub and an AI testbed, fits in. It's about building a vertically integrated ecosystem. Their manufacturing strategy, unlike some competitors, leans heavily on a strategic partnership with Stellantis, the automotive giant, which provides crucial manufacturing expertise to help scale production quickly and efficiently. This asset-light approach, focused on design and core technology while leveraging a partner for heavy manufacturing, is a major differentiator. Past performance, however, is a non-factor in the traditional sense, as the company has no meaningful operating revenue and exists purely in a developmental and capital-raising phase. Older reports simply show consistent, heavy losses, which is expected for a pre-commercial business in an entirely new market. This is why valuation relies so heavily on future potential, market size, and, most importantly, achieving FAA certification, which remains the single biggest hurdle. Investors are funding the promise, which makes the stock highly sensitive to any perceived setback, like the major dilution event we've just seen. The current financial metrics, such as the negative price-to-earnings ratio and lack of revenue, mean that investing in Archer Aviation stock is a conviction bet on the future of urban air mobility. This is a far cry from managing a conservative portfolio with Schwab Intelligent Portfolios or traditional mutual funds. The future outlook is a spectrum of possible outcomes, each tied to a specific catalyst. The most immediate crucial catalyst is the FAA Type Inspection Authorization, or TIA testing, which is a major step toward commercial service, and which the company is targeting for the end of the next quarter. Hitting this milestone would instantly validate the technology and provide a strong counter-narrative to the current stock dilution pessimism. Another key opportunity is the aforementioned defense side, which could provide early cash flows and further de-risk the commercial path. The partnership with the U.S. Air Force's AFWERX program is significant, and a large concrete order would be a massive win for sentiment. On the risk side, the primary issues are regulatory delays, the FAA process is notoriously slow and complex, and the ongoing pressure from the burn rate. Even with $2 billion in liquidity, the operating losses will continue to chip away at that cash, meaning they must execute their plan quickly and efficiently. The entire eVTOL sector remains a very high beta trade, far more volatile than established names like Apple stock or Tesla stock. The correlation with speculative sentiment, especially on online investing sites, is high. The recent stock movement shows the tension. Expectations were high that the company was in a smooth flight path following great test results, but the reality of the massive capital requirement, the dilution, has sharply reset those expectations back to a more cautious level. The market is now waiting for the next clear evidence of operational execution to justify the higher share count. This entire sector is a fascinating study in how market sentiment and capital structure interact. Comment below with your honest take. Are you a buyer of Archer Aviation at this diluted price, seeing it as a necessary evil for a long-term play? Or are you staying away until the FAA TIA is officially secured? The answer to that question reveals your personal expectation versus reality framework for speculative growth stocks.